Well, good morning, everyone. My name's Iain Craig. I like to call myself BDO's Eye on Tax for obvious reasons. I am joined by my good friend Mark Lodder from our Christchurch office.
Morning,
Hi,
all.
Mark.
Morning.
And we're here to host our second webinar for the year, our Eyes on Tax webinar, which I have entitled The Problem with Tax. And of course, one of the problems with that title is there is no such thing as one singular problem with tax. There could be multitudes of tax problems. It could be that you have difficulty paying the tax. It could be that there's too much tax being collected. It could be that the tax questions or the obligations are too complicated and difficult to comply with. What we're going to do today is cover off four topics which we think are trending in the tax world, if you like, and it covers off an area of which is quite an interest to some people, which is the fifth regime and how it interacts with attracting new capital and ideas with new individuals coming to New Zealand. We'll go through the increase in audit activity we're seeing with Inland Revenue, a recent publication by Inland Revenue on overdrawn shareholder current accounts. And of course, we're 2 years into the new disclosure rules for trusts, and we're going to reflect on some practical issues from that 2 years. Now, we do hope to have time for questions, but if you've been to one of our webinars before, you know that Mark and I do tend to try and cram too much into those webinars. We might run out of time. We're on a new platform this time, so the question, there's a button at the top of your screen which will give you a Q&A. If you can submit your questions during the presentation, we'll either address them as they come through or at the end. I'll do our best to do that. So let's crack on. So why are we talking about FIFs or foreign investment funds? So this is the taxation for offshore investments or offshore equities in particular. And the reason this is topical at the moment is that there was a report issued by the New Zealand Institute of Economic Research. It had been commissioned by the American Chamber of Commerce and various other organizations to question whether our tax settings were having an impact on immigration into New Zealand. And that's immigration at that entrepreneurial level, at the investor level, where we're trying to attract people who can come and run companies or start companies and manage a business from New Zealand that can grow without necessarily being close to the market that you normally have to be. It got enough traction, and because they'd identified that there is a tax problem with the way we tax their offshore investments when people arrive in the country, that Nicola Willis announced that she would be asking the Inland Revenue to put a review of the fifth regime onto the tax policy work programme with Inland Revenue. So there is potential for some reform to be coming through in the near future, shall we say. So we'll explore that report. So one of the problems is, New Zealand is an importer of capital. We've always sort of required that welcome new migrants to the country, particularly with particular skills, talent, capital, or that can help boost our productive economy. And the New Zealand Institute of Economic Research found that there had been a significant decline in the number of entrepreneurial visas and investor visas categories that had come in dropped down, I think, from something like 9,500 down to about, or 9,000 down to about 3,000. So about a third in recent years compared to 2008, and that was a concern. New Zealand Institute of Economic Research interviewed people who had left New Zealand and also people who were potentially contemplating leaving New Zealand. So that was a concern because it wasn't just about attracting people to come, but it was also making sure that they stay, because if they leave, then there's no basis for taxation. So fundamentally to our tax system is two concepts of residence and source. So a New Zealand tax resident is liable on their worldwide income. when somebody becomes a New Zealand tax resident, when they first move to New Zealand, or if they're a returning New Zealander, so somebody who's been out of the country for more than 10 years, then there is a 4-year exemption for offshore passive income. Now that was a 4-year exemption that really helped attract people to come to New Zealand. It was to enable us to attract that talent and give people time to work out how to structure their investments once they got here. Now, if you're a non-resident, so you're not tax resident in New Zealand, then you're only liable in New Zealand to New Zealand sourced income. And we'll come back to those concepts later. So we end up with, we attract a high net wealth individual or a founder of a tech company down from the States to come and live in our great country, and we look to tax some of those investments once the 48-month period is over. And our offshore equities, there's fundamentally sort of 3 common FIF calculations, foreign investment fund calculations. One is the fair dividend rate, which is the sort of default calculation, which is 5% of opening market value. Now, this is on a portfolio interest of in an offshore equity of less than 10%. And that's fundamentally that you're calculating fifth income based on 5% of the paper value of the company at the start of the year, or paper value of the shares at the start of the year. Now, as a concession for individuals and trusts, if the closing market value of their shares have dropped to an opening from the opening market value, then you can modify that fair dividend rate calculation down to as far as nil, so that there'd be no fifth income in a year if the drop is greater than the 5% of the opening, the FDR calculation. Now, for unlisted investments, there's a cost method that can be applied, and in the current bill in front of Parliament, there's provisions just to shore up the position that cost method can be used when it's practically difficult to find to reach a market value. The FIF regime also has a couple of other methods which are generally used for larger investments or super funds and things like that.
Iain, can I just sneak in here in terms of the methods available to the taxpayer, and a lot of the problems we face is not knowing what you don't know. So when we talk about FDR, for example, versus CV, just please remember to apply the method consistently across the whole of the portfolio. You can't cherry pick Nvidia, for example, to use FDR and British Airways for CV. So you have to use the same methodology across the board.
Did you know that British Airways had gone down in value?
I've got no clue.
No, that's a good point. And look, we're only covering the very high level outline of the FIF regime because we want to get to some of the issues. So fundamentally, you're paying, you're calculating fifth income. So the tax is not 5%; it's the income that you're deemed to derive from that offshore investment is 5% of a notional of a market value. So the question is that this is fundamentally you're paying tax on income that you might not receive any actual dividends. So obviously, if you're in FDR and you receive an actual dividend, the actual dividend is not taxable. Okay, so there's no double up here. They're just saying that if you are investing offshore, you should be expecting a return of 5% of your value. And we're going to tax that on a sort of, as a concept of, if you like, economic income, which is a concept I particularly detest. And that was one that was, I think income should still be income. It's something that comes into your bank account and something that you can realize. But an economic income was sort of some of the capital gains tax discussion or wealth tax discussion that was being explored prior to the election. So it fundamentally, the tax payable may be you may have to pay tax on a fifth income amount when you don't have actual dividend cash coming in. It might be, but in other cases, you might have a win where you've actual dividends greater than your FDR income. But if you imagine some of those big tech companies, even the Microsofts of the world, they took them a very, very long time before they started paying dividend, because their approach was to grow and grow and grow, and the share value was going up like that, and you didn't get a dividend. So FDR would be particularly hard on that type of stock. NZIER, the evidence that they've gathered from their research would indicate that new migrants with key skills or capital this is a potential block. In fact, they quote in their report that they're leaving the country, heading off and saying New Zealand's got a hostile tax environment for their offshore investments. I find that quite hard, because I spend a lot of time telling them what a tax haven we've got down in New Zealand. We don't have stamp duty, we don't have death duties, we don't have a capital gains tax, but we have just got this sort of, if you like, a quasi capital gains tax or a quasi wealth tax just in relation to foreign investment funds. So it's a potential block for those migrants. Interestingly, there's been a recent, it's been difficult to get data on how much FIF income is returned, and they've only recently started to gather that data. And the revenue that's been released through an Official Information Act requirement response by Inland Revenue would indicate that it's a relatively low amount of income, and that would sort of suggest that either we've got a complex, the amount of income is quite low for the complexity that we've got to deal with, so that's probably a bit unfair from a tax setting point of view, or it's maybe still too hard to comply. So I'll share with you now the revenue information that's come through. And I was put onto this by a fellow a tax podcast from Terry Boucher, which I thought was quite interesting. So I just want to acknowledge that he had identified this, and he got it from another source of accounting firm. So anyway, it's public information and it's available. So the overseas income for individuals, about $2 billion in 2023, and the number to date is about $1 billion of overseas income. Now, I think that's on a part year tax returns filed 31 August 2024. So, we're still getting tax returns being filed through to 31 March. So that number is likely to climb. But the amount of fifth income is only around $190 million out of that 2 billion. So that's significantly low. So, which is, led to some of those commentators to comment on whether they had paid tax. Is it being complied with correctly? From my point of view, I was sort of thinking, well, that could be that the markets have dropped and the comparative value has wiped out the FDR income or in that year. So that actually it may be it just is a fact of the change in the markets that we've been able to change from an FDR point of view to a CV point of view, or it may be the way in which they're disclosing it in their returns. The number of individuals declaring it is also relatively low. The NZIER questioned whether that's because of the number of migrants coming to New Zealand. They might still be part of the 48-month exemption. I sort of jokingly thought maybe it's because they cash up all their offshore investments just to pay for a house when they get to New Zealand, but it's surprisingly low. So I think there'll be more data to come in relation to this. So what did NZIER propose as a reform? Well, they said, look, if we are missing out on somebody who could found a tech company because they've got investments in tech companies or different companies up in the offshore, where they don't want to end up paying tax on a notional income, and and they're unlikely to receive actual dividend income, then that's a preventative. So to solve that would be to create sort of a 3 regime. One where you've got, if you've always been a New Zealand tax resident, then you're liable on your worldwide income. If you're becoming a New Zealand tax resident, so that's somebody like a new migrant or a returning New Zealander who's been out of the country for more than 10 years, then you could get a ring fencing of the investments that you arrive in the country with. So that would be, take all your offshore investments and sort of ring fence them indefinitely. And that's they described that as a foreign replacement income position, so that maybe once you sell those investments and buy new offshore investments, those new offshore investments would come into the 5th regime. Or you would, or there might be a hybrid that also requires you, if you make further investments in the same companies that you had when you arrived in the country, that you would, that would be, the new investments would come into the regime. And obviously the source income would stay the same. If you're non-resident, you're only going to get taxed on New Zealand sourced income. So I think that's quite an elegant solution. It's it would be relatively simple to implement. You're going to have some analysis, and I presume this is what the Inland Revenue will be working on through their tax policy work programme, and to see whether that is the right reform. But hey, I thought the 5th regime might be ripe for reform, so I came up with my top 5. And these are not backed by economic research or data. This is just my personal one. It doesn't mean that the firm BDO necessarily agrees with me, and maybe that Mark may not even agree with me. But one of the simple things, and I had the pleasure one day of having lunch with Robin Oliver, who was the head of tax policy for close to 20 years, if not more than 20 years. And I asked him one day if there was a piece of legislation that he was most proud of that he'd introduced into the tax framework. And he thought the FDR regime had solved a lot of non-compliance problems with the previous 5th regime, which had been introduced in the 1990s, when our tax system was very open to abuse with Cook Islands wine box type situations. And he thought, he said maybe the 5% was a bit too high. So simple thing might be to reduce the FDR from 5% to 3%. That would ease a bit of the pain, wouldn't it? The second option would be to revert back to a cash basis. Income should be income that comes into your accounts. So it would go back to an actual dividend income received. Now, does that sound simple? Well, we did that with offshore pensions, which were also part of the early 1990s 5th regime. And we turned that back to a realised basis. So we're offshore lump sum settlements of offshore pensions are taxed at a certain percentage, depending on how long you've been in the country. The third of my options for reform would be to extend the transitional tax residence exemption from 4 years to 10 years. So if you remember that slide where you first come in, you get a 4-year exemption if you're a new migrant or a returning New Zealanders. Well, you could extend that out to 10 years. So why did I pick 10 years? Well, there are venture capital exemptions for people who've started companies in New Zealand but that have to migrate offshore to be able to get additional equity finance and grow the business, and that venture capital exemption lasts for 10 years, and it also applies to somebody who has shares in a company that owns a substantial venture capital business in New Zealand. So there's a symmetry there between 4 years and 10 years. Essentially, that is the same or a similar reform to NZIER's recommendation. Minor things could be allow companies to use the modified CV method. And lastly, we could go back to a wider grey list exemption. At the moment, we've got a grey list exemption for ASX listed Australian companies. We used to have a much wider grey list, the US, Canada, UK, France, even Norway, Germany. So maybe we could extend the grey list exemption for there. all of those are trying to, would reduce the amount of fifth income that we are earning, and that's all. A reduction in tax is always a bit of a concern when government is hungry for tax revenue. But if it helps us to attract talent, skills, and capital, and keep talented skills and capital in New Zealand, then the economy should do better for it. And that's the theory. So, Mark, what do you think of those reforms?
Iain, I think I should start off by saying that most of the time I do agree with you. It's only by exception. For example, is the English football team better than the Scottish? Well, yes, it is. You might have a slightly different view, but no, I've got a lot of sympathy in particular for, I think, your third of your top five, more mirroring what perhaps the Australians do with their special category visas and allowing, effectively an indefinite transitional residence period, providing you don't become a citizen or I think marry a citizen of Australia.
Yeah.
So they are quite friendly in that regard. I think I quite like number two as well, but we should just remember that the attributable fifth income method effectively does that, but you can only sneak into that if you've got I think it's a 10% or more holding, which doesn't really fit for a portfolio of listed entities. So it's very restrictive in how you can use it. And probably my last point on a fifth regime review is we should be careful what we wish for, and the unintended consequences. I'll talk about a bit more about unintended consequences later, but there are some things in the fifth regime which can create the winners. So, for example, you've got a dividend-heavy investment that might return 10% of opening market value. You're only taxed on the 5%, so there's a win there. And also the fifth regime, one of the clauses or provisions in the legislation says there can be no other income other than fifth income as a rule, which means if you are a trader of foreign investments, which would be subject to the fifth regime, you can't get caught under one of our business tests, which is different to if you were trading in domestic. So, look, just a quick on those fifth reform ideas, but I think all very valid, Iain.
I think
nice.
And I think the Australian example is they've got a similar transitional tax residence exemption, but it's indefinite, which is kind of closer to the NZIER provisions. So, and part of why we need to compare ourselves against other countries is that it's a competitive market, and people who are willing to change countries may find that the tax system is a significant significant component part of the decision as to where to move to and to live. So if we want to attract that capital, that talent, and that skills to New Zealand, we need to have a competitive offering. And this, the research from NZIER would indicate that that it is a problem tax for many.
Yeah.
Okay.
Okay. Okay, so this slide, you might be forgiven to thinking it's one of those Facebook conundrums where I put some matchsticks on a page and you've got to change one of the matchsticks and make the formula work. Clearly, 29 million doesn't equal 260 million, but this is part of the reason why we're talking about inland revenue audit activity or risk reviews and disputes. So evidence or statistical information would suggest that for every dollar inland revenue spends on investigations, there is a return of around $9, 8.92 if we're going to be precise. So that's why 29 million equals 260. And the 29 million has come from the last budget. So at the last budget, inland revenue received 29 million to fund supporting compliance. So funding supporting compliance is a nice way of saying more investigation work. So from our perspective, what we are seeing is audit activity or risk review activity, inquiry is on the increase, and we consider it will continue to be on the increase over the next couple of years or so. So managing inland revenue audit activity and disputes. I actually really enjoyed this slide before we changed it. So we, when we first started this and we put the traffic lights in, we forgot to put the words in like don't. So if you read it cold, one of our recommendations is to be offended. But there's quite a lot of common sense in here. So one of the don'ts is don't be offended. So Paul Mersey, who is he is the Commissioner of Inland Revenue, but I think he's recently been seconded to Treasury. But Paul Mersey mentioned that most people do the right thing. So 90% of customers, inland revenue taxpayers, are referred to as customers. 90% of customers have got no debt, and they find meeting their obligations straightforward. So it's not, you don't need to be offended. It's not necessarily adversarial. This is just inland revenue doing their job. Don't lie, pretty obvious. Don't miss deadlines. Again, it's fairly obvious, but if you are going to miss deadlines, these things happen, then again, apply a high degree of common courtesy. Let the person know, explain why you're missing the deadlines. From our experience, inland revenue are more than reasonable. If you simply can't meet a deadline, the best approach is to let them know before you miss it. Same with everybody. And the other piece to think about is don't withhold information unless you have tax privilege, which I'll just talk about in the next slide. But inland revenue's powers to gain information and collect information are widespread. Very, very hard to withhold unless you have that tax privilege. So some of the things you do need to consider with managing audit activity is think about tax privilege. So don't forget some tax advice or tax advice with the right disclaimers or headings put on it, i.e. this is confidential subject to tax privilege. That's information inland revenue isn't privy to. It's our legal privilege within the tax regime. Don't forget though that with tax privileged information, what they call, I think they call it contextual information. Background facts, that isn't privileged. So background facts to a transaction still remain something that is available for inland revenue to see, but taxed privileged advice, potentially not. But that's not to say don't disclose it. It might actually be in your favour to provide inland revenue with the advice that you have received, knowing that it's robust and is on the right track, and just helps inland revenue draw the dots quicker than otherwise they might do. Disclosure. This one is really, really important when we're talking about penalties or the potential imposition of penalties in the event something is found. So if we are in a pre-audit or pre-notification of an audit situation, so it might be more like a risk review. If we make a disclosure of perhaps something that we consider we have got wrong to inland revenue during this process, most of the time, any shortfall penalties that may be considered to be imposed are reduced by a full 100%. So lack of reasonable care, for example, that shortfall penalty in the event you have disclosed the position to inland revenue pre-notification of audit, your shortfall penalty exposure is reduced to zero. If it's post-audit, so post-notification of audit, I think it's around 40%. So you get relief for 40%. So what you should consider is, albeit it's inland revenue having a look at you, in order to work out whether you should disclose or not, it's often a good idea to do your own review. So have a look at what they're asking, have a bit of a deeper dive. Is there anything in there that would make sense to let inland revenue know before they come and ask you about it? The last thing to consider is audit insurance. There are products out there which will, subject to terms and conditions, pay for the costs incurred or professional fees incurred in managing and responding to audits or risk reviews. They're not going to pay for your core tax or your penalties or your interest, but your fees incurred in managing those audits or risk reviews can be covered by audit insurance. So it's something to think about. The dues. So inland revenue works on a risk basis. So they're not gonna, if they're gonna try and collect $8 or $9 for every dollar spent, they're not going to waste their time on lower risk taxpayers. A lower risk taxpayer can be one who has really thought about their tax affairs and tax governance. So think about this in advance. Do you have a tax strategy? Do you have processes and procedures that will steer you in a tax direction? Do you have a tax payments calendar that you can follow? All of these things showing that you are somebody who is seeking to be compliant and therefore reducing the risk in the eyes of the commissioner. I think it's always important to assume Inland Revenue has perfect knowledge. You're not going to be able to hide anything. Assume whatever's out there, Inland Revenue will be aware of. And lastly, do be helpful. The quicker you provide the information, the collaboration, the friendliness, all of those types of things, the quicker you can move away or resolve any Inland Revenue inquiries, etc. So that is Inland Revenue audit and disputes. Formal dispute process. If in the event Inland Revenue does find something and you may or may disagree, there is a formal dispute process. We've outlined it here, but in the interests of time, the main thing that you really need to think about with a formal dispute process is deadlines. This isn't a case of saying I'm going to miss the deadline. You might be able to renegotiate an extension, but on the whole, deadlines are legislatively driven. You need to respond or make sure you've got your paperwork delivered within certain timeframes, normally 2 months from issue of certain documents. So please be mindful of timeframes. You'll note right in the middle of this, we talk about conference. This is the opportunity to sit down with Inland Revenue and thrash out the issues and have a chat. Look, from our experience, you could do this at any time, and we would encourage it. Normally, more than willing to talk things through. So, conference is in the middle of the formal disputes process, but I wouldn't be afraid to be talking to Inland Revenue throughout. So, remedies. So you find yourself in a position where you do have some tax debt. How can you alleviate some of this pain? So our starting point is, what can we do with negotiating with Inland Revenue? We can talk to the Inland Revenue about entering into an instalment arrangement. Now, an instalment arrangement needs to be reasonable. You're very unlikely to be successful with an instalment arrangement as an exaggeration that pays $1 per month for 50 years. That's not going to work. So when you're looking at instalment arrangements, yes, be reasonable, don't be unreasonable. Think about lump sum versus periodic payments. We often look to see if we can get a lump sum payment up front and then followed by reasonable periodic payments. The big thing with instalment arrangements is make sure you keep your current tax obligations up to date. It's no good remedying the past and forgetting about the current. Make sure that you are still able to maintain your current obligations. We have core tax write-off. So under certain circumstances, Inland Revenue will consider writing off core tax. That's normally with serious hardship. So whether or not serious hardship exists will be a combination of many factors, including ill health, cost of schooling, what other impacts or other factors could come into play which would cause serious hardship to the taxpayer. We can look to remit penalties. As I mentioned before, disclosure is your best avenue to remit penalties. Remission use of money interest, we put it in there, but not very, very seldom will you be able to remit use of money interest. But when you are negotiating with Inland Revenue, as with any other person, often best to put yourself in their shoes. So what's the Inland Revenue's objective? So overriding all of this, Inland Revenue will be thinking about their two objectives. Their two objectives is to protect the integrity of the tax system which means it needs to be fair, applied consistently. We don't want to undermine it. And then secondly, they have a duty to collect the highest net revenues over time. So those two things should be borne in mind at all times when you're negotiating with Inland Revenue, because this is what they are working within. Now, the second one is taxpayer driven and tax pooling intermediaries. Now, I'm not going to tell you all about what a tax pooling intermediary is. They've been around for a long time. I'm sure we all know what they are. But when I was thinking about this, I thought I would introduce a bit of Christmas spirit, given that we are approaching Christmas, when we talk about tax pooling intermediaries and the problem with tax. But the way this started is, so Iain and I, as you'd expect, we practice these seminars or webinars and think about what we're going to say. And it reminded me of a nativity play that I did at primary school many, many years ago. It is a long, long time ago. And I played the part of the angel Gabriel. And the teacher said to me, whatever you do, don't stand up and say you're the angel Gabriel. So I stood up and said, I am the angel Gabriel. And it's a bit similar with this one here. Ian's probably going, where's he going with this? But we had a chat about this and we agreed that I wasn't going to talk about this point for tax pooling intermediaries, but I will. So tax pooling intermediaries, they're really good. Mitigate late payment penalties and reduce your cost of use of money interest in effect. But what we've got to be really careful of is if we don't look at the unintended consequences of doing something. So using a tax pooling intermediary is all well and good. We get some wins over here. But what it does, it's a bit like a back to the future effect. If you meddle with the past, it might impact on the future. So for example, a taxpayer has gone back and paid some, bought from a pool and has paid some old tax and generated an imputation credit. If there was a breach of shareholder continuity in between the old or the new payment date back in the past to current day, then effectively we might have saved use of money interest, etc. But those imputation credits, which were a credit to our imputation credit account in the past due to tax pooling, are lost because of a subsequent breach of shareholder continuity. So tax pooling intermediaries are fantastic, but just be really careful that there isn't an unintended consequence or loss if indeed you lose the imputation credits that arise from using the pooling intermediary. I told you there was a link, didn't I, Iain?
Yeah, I'm still not sure what point you were getting to, but never mind.
Don't say it, but I did. But anyway.
Look, I think there's a lot. What we're expecting is increased audit activity through risk reviews and audit, as you said. And certainly, I remember when the voluntary disclosure regime came in, there was a lot of nervousness that if we made a voluntary disclosure when we found we had made an error, inadvertent error, a human error, or a tax position that was incorrect, that it would trigger an audit. And the reality is it hasn't in most cases, so we should never be frightened to make a voluntary disclosure. It does result in those shortfall penalties being fully remitted, and it shows that you're taking your tax position seriously. So, okay, there's lots to unpick in terms of that audit. Look, I want to go back to a bit of basics here, and this has been driven by an interpretation statement that's been issued by Inland Revenue, and Inland Revenue issue out a large number of quality products that are publications to help guide compliance with the regime. So fundamentally, you've got a business that is generating cash. It goes to the generates the cash to the company. The entrepreneur, the shareholder who owns that company, often doesn't distinguish between cash that's earned by the company and cash that they've been paid to, and withdraws the cash from the company and drawings. Typically, they might go and spend it on, the boat, the batch, the BMW, or the Bentley, or whatever, and any particular toys that they want. And at the end of the year, if they've drawn more out than they've been paid, then they have an overdrawn current account. So you've got to assess what you should do with that overdrawn current account. We've got lots of rules around If that loan is at low interest, then there will be a deemed dividend. If it's to a shareholder, if it's to a shareholder employee, then there could be a fringe benefit tax on the interest-free benefit of the loan. So there's some tax consequences there, and the way to resolve it and to clear it is a couple of options. You can, if it's to a shareholder, you can declare a dividend. Presumably, if the company is profitable and generating cash, it's paid tax, it's got imputation credits. They'll have that top-up tax of resident withholding tax of 5% to take the tax up to 33%, which is paid at the individual, paid by the company, but is a tax credit that is applied against the individual's tax consequence. And then there'll be a further top-up to 39% if the individual is at the top marginal tax rate. 39%. The shareholder employee, you've also got the option to allocate salary. It's deductible to the company, taxable to the shareholder. Tax can be collected through PAYE or provisional tax, typically provisional tax. It's under both the dividend and the shareholder employee, there's a retrospective crediting of the dividend or the shareholder employee salary to the start of the income year, or the earliest point at which the current account becomes overdrawn. And that's to then eliminate out the risk of FBT or a deemed dividend arising out of a low interest loan. Now, let's say you leave the current account in place for a long period of time, then you have to charge interest. Otherwise, you've got that FBT or deemed dividend provisions on it. The interest will be taxable to the company, ABC Limited, and typically it'll be non-deductible to the shareholder, ABC, Mr. ABC. And it's non-deductible because he spent the money on private lifestyle assets or living expenses. Also be careful around the terms and conditions. Typically, a shareholder current account is regarded as a bit of an informal arrangement between the company and the shareholder. But in a cross-border situation, there's a lot more documentation required. And that's because we've got things called transfer pricing rules where a transaction is going cross-border. So if the company is generating surplus cash and the parent company is accessing that cash, perhaps through a cash pool to fund treasury and finance elsewhere, or is just borrowed, is taking the money out of a cash generating business, then that loan needs to be have interest charged at it. Otherwise, it's going to be a deemed dividend to the parent company. There is ability to attach with imputation credits to that, and if it's fully imputed, there's no withholding tax on the dividend. If you're charging interest, you've got to justify the arm's rate, and that goes to the terms and conditions that apply to the loan. And with a current account that's trading account from, it can also be a current account which is driven by the movement in goods and services between the company. But it also could be just funds that have been lent up. So you need to sort of separate that out and document it carefully. So what are the lessons to take away from this interpretation statement? Look, I think it's a really clear guide. If anybody's wanting to look at it, and it cover dealing with their overdrawn shareholder current account, it's a good reference point. There's also a short fact sheet that you could have a look at as well. But it's it clearly shows how to calculate the timing of when the dividend or salary can be credited for the purposes of calculating the interest. You'd be surprised at how many regimes that this sort of arrangement touches: financial arrangement rules, resident withholding tax, and it goes through all of that. For me, the documentation requirements for a cross-border shareholder loan, I think, should be applied to the documentation for the company and a domestic situation. I think there needs to be discipline around shareholder current accounts. In my view, building up an overdrawn shareholder current account is rarely sustainable. If you're drawing that money out to live on, that should be in the nature of shareholder salary. If you're drawing it out to pay for things, you can borrow from the company, but you must have the obligation to repay it. And if you don't, it's a problem that just gets bigger and bigger and bigger. And if your company ever gets into trouble, that's an asset that can be called upon by a liquidator going into that company or receiver going into that company and claiming that back from the individual. So lots of overseas jurisdictions do not allow current accounts to become overdrawn in this manner. And I think this is an area that could be tightened up from a legislation point of view. But the current legislative tax settings at the moment has it that the interpretation statement stands, and it's a really good reference document. So for me, it's about discipline, pay dividends, forget the fact you've got to pay a 35% resident withholding tax and 39%. It's good to pay that because it gets the money out of the company and protects your assets as an individual shareholder or a trust from future claims against the company.
Yeah, I think I agree with you, Iain. Without the discipline, there is a risk that overdrawn current accounts start to look more like income than a loan. And don't forget, one of the problems with our cross-border loans is, as you mentioned, having to apply a market value rate of interest. What's a market value rate of interest? One of the solutions we do have is Inland Revenue's kindly produced safe harbour thresholds for transfer pricing. So they do provide for low value loans, I think less than 10 million. There is a rate of interest that you can apply without having to go through a whole process of trying to work out what true market value is or what the true rate of interest should be for that particular loan. So don't forget, there are some friendly guidelines in that regard. Practical issues for trusts. I think we've done quite a lot on trusts in a prior seminar. But we'll start off with the accidental settlor. The definition of a settlor is really widely defined for New Zealand income tax purposes. If you talk to overseas jurisdictions and you ask them who the settlor is, they'll send you a copy of the trust deed and point to the name on the front that says the settlor is the lawyer. Now, the settlor for New Zealand purposes is someone who transfers value to a trust, and settlor is really important for our purposes because that will drive how the trust is taxed. The problem with an accidental settlor is largely around I think the new rule or fairly new rule, which talked about beneficiaries providing loans by hook or by crook to the trust. If a beneficiary is owed more than $25,000 and doesn't charge interest, then that beneficiary can be deemed a settlor of the trust. The ramifications of that are around what benefits or entitlements, welfare entitlements the beneficiary may be entitled to. That can change. Also, for the purposes of the land taxing provisions in particular, that beneficiary becomes an associated person of the trust. And if you're an associated person of the trust, you could walk into all sorts of those tainting provisions that, look, historically we have and other people all talk about, the 10-year rule, etc. So becoming a settlor of a trust accidentally can have some ramifications. So compliance and cost. Now, I think these rules or the new disclosure regime, I think Iain mentioned, came into play about, say, two years ago. And these disclosure rules were brought in to keep tabs on trusts when the trustee rate was at 33% and the highest marginal tax rate was at 39%. So the additional disclosures required for trusts, I think, are probably largely redundant now that we have a 39% tax rate for trusts and for individuals. What are we trying to work out? Well, the reason for having it has largely been diluted. So one of the problems with this additional compliance is that, look, potentially we do have too much red tape. The red tape or the disclosures that we're being asked for aren't there for the reasons that we originally had. And we can have a double up of information. So you may have various pieces of information that you've already got in a different guise, but then you have to put it into a different format so that it goes on one of Inland Revenue's forms and they can readily use it. So there's all sorts of problems here, but also there's the confusion. So if I draw to one of the disclosure requirements is that all distributions to beneficiaries need to be identified and quantified. And this will lead into our last triangle, which is on the anti-streaming trap. But if, for example, we have a trust that the family home or the beneficiaries are living in the family home and they're not paying any rent for it, then in theory, the trust has provided a distribution to those beneficiaries. And does that distribution need to be disclosed on a beneficiary per beneficiary basis? Because that's what we're required to do. Sorry, e.g., we'll just go back. We're not quite there yet. I think the view is, and I think it's in Inland Revenue documentation, is in the case of a disclosure, has there been a distribution to the beneficiary that needs to be disclosed to Inland Revenue? The value of that distribution is nil. Now, if we then look at the next slide in the anti-streaming trap, we can end up with a slightly different answer. So we have an example here, and I've changed the names to protect a bit of anonymity, but we have David, Carol Ann, 3 children, live in a family home owned by the family trust. The trust also receives a fully imputed gross dividend of $100 from a company that the family trust owns. David does a lot of running, doesn't earn much income, and has a lower marginal rate than that of the trust and Carol Ann. So what we do is we go, well, given he's got a lower marginal tax rate, let's transfer all dividend income to David as beneficiary income. And we can avail of lower tax rates, and perhaps I think we would convert excess imputation credits to a loss that we can utilise at a later date. Is it a problem? It can be in this regard, because Inland Revenue, or there is documentation or guidelines, interpretation statement out there that says any property of a trust that is provided for less than market value to beneficiaries is a distribution that should be valued. And if it is a distribution that should be valued, then we need to look at the anti-dividend or the anti-imputation credit streaming rules that apply to trusts. And what these rules do is they look at the person's distributions, divide it by total trust distributions, which would be the $100 gross dividend plus the value of the home, and times that by the beneficiary credits, i.e. the imputation credits. And that's the imputation credits that would be available to David in determining the tax liability that arises from receiving the $100 beneficiary income distribution. This is in direct contrary to the disclosure requirements, which would suggest that the value of the distribution is zero. So there is a bit of confusion there. So what do we do with this? Well, the answer might be simply to have multiple trusts. Have a trust to own the family home and a trust to earn income, which seems a little bit overkill. One of the other things that we're seeing that's trending at the moment is that a lot of persons are reevaluating the need for a trust. So do the risks that cause them to set the trust up, are they still there? That still leaves the trust with a valid reason. So we've set a trust up to protect from risk of challenge or commercial risk. If you're not working, has the commercial risk gone? The trust is there to, I think Iain referred to rat bags that your children might end up in partnership with, in a relationship with. If your children are well settled and have moved on, etc., does that risk really present? So we are seeing a trend where people aren't using trusts quite as readily as they might have been in the past. I'm trying to think, Iain, was there anything else you had on trusts?
Yeah, look, I think while we're seeing the extra disclosure, like to me, this anti-imputation dividend stream rule, because you're a beneficiary of a trust that owns your house and you haven't charged yourself rent the use of that trust. You're not paying the maintenance costs. You've got this sort of valuation of a benefit of a distribution. It's bollocks. It's way overreach around this imputation streaming provisions, and I would say that this is an area that should be reformed because it's an extra compliance cost that shouldn't have an impact. It's just and if it was the source of income was interest with resident withholding tax, there's no streaming provision there. So what's the mischief here? The tax has been paid, the imputation credit should be allowed, and and if imputation credits were refundable, it'd be sensible. So I just and to force people to put their houses into a separate trust that becomes dormant and have their business owned by a business trust, which a lot of structures were set up that way anyway, but it's just adding to extra compliance costs and extra trusts as well. So hopefully we could see some reform in this regime. And your point about the trustee rate going to 39% may well be the catalyst for doing that. So we've got a couple of questions, which we've got one, Mark, which is up there, which I'll let you consider around interest and deductibility, but we'd had one pre the session. And how much would fifth tax regime, FDR and CV, determine people's influence or appetite for investing in offshore international shares? And I think this is it's an interesting question. I think in our experience, people put their money generally into managed funds, and the managed funds, they will just manage it. You don't want the tax tail wagging the commercial and investor dogs. So you wouldn't want to restrict your access to international markets just because of the FDR income. It becomes a wee bit more complicated if you end up with a shareholding in unlisted securities, and that may have an influence on it. Do you think the tax is fair and reasonable? Well, I think, as we mentioned, Mark, there's some winners and some losers, and it can depend on the type of investment that you make in that FDR. Like, we don't tax economic income in any other capacity, so this is a quasi wealth tax or a quasi sort of capital gains tax, albeit only a portion of the capital gains tax. So, it's your own perspective as to whether do you think it's fair and reasonable. Any common mistakes? Well, look, there are, there common mistakes. I think there are. There's a lot of complexity with the fifth regime that people would not understand, and we've had a common automatic exchange of information, which has generated more queries a few years ago. So 2 or 3 years ago, the Revenue ran a program where they'd been getting data to say that there had been bank accounts overseas or there had been some information overseas held, and clients would approach us and say, or new clients would approach us and say, actually, I forgot to tell you about, I've got a portfolio of shares overseas. I thought it was all held in that overseas jurisdiction. It was kind of my retirement fund. I didn't realize I had this fifth regime that I had to apply. So it's getting through to some people in relation to that, but the automatic exchange of information, the common reporting standards, it is the Revenue we're finding out about those things. So I think that's kind of not understanding it is probably the biggest issue.
I think using a method that's not available to you is a possible mistake. So you've got to be really careful with the FDR or the fair dividend rate, because there are certain investments which are excluded. So if the investment carries a fixed rate of return, for example, if you don't look at the detail there, or if indeed there is absolutely no chance of receiving a dividend, I think that might be a problem too, because it starts to I think it changes the ability as whether or not you can use that FDR as an option. So this is a great question. Someone incurs borrowing costs to acquire offshore shares. Once the 4 years has passed, so that's a reference to the transitional resident rules, and fifth income is generated and taxed, will they be able to claim a deduction on the borrowing costs? So I would say yes. So there's a direct nexus to the incurring of borrowing and deriving of taxable income. But I think here, this is where you think about your planning. So just because transitional residence is there, it doesn't mean you need to take it. So there are circumstances where you may turn around and actually revoke the ability to use the transitional residence exemption if the ability to claim a deduction on the borrowing costs would give you a taxable loss that you can utilise. So dropping into TR isn't necessarily always the right thing to do. You can revoke it, but remember it will revoke all passive foreign, not just that single one you're looking at. If there's an advantage, and the revocation I think is irrevocable, so you can't change your mind at a later date. But that's a really good point to draw out. You don't have to take TR if it would be in your best interests not to apply the concessionary treatment.
Correct. Okay, I think that brings us to the end of our presentation and our webinar this year. The usual disclaimer applies. This is sort of high-level information, general information, so every tax circumstance depends on your facts and circumstances, so seek advice from your local BDO advisor. And lastly, we'll be back next year for more webinars, so watch this space. And who knows, we might be actually talking about the reforms of the fifth regime that may well have come in by that time.
Can I just say a thank you to E.G. and Jamie for helping us with their presentations this year. And as Jamie has asked us to do, and it is going to undermine our credibility not only with the nativity play, etc., but Jamie wants to wish everyone a merry Taxmas.
You were determined to get it in, weren't you? So
I was. Thank you, Jamie.
Right. Okay, thanks everyone. Thanks for attending.
Cheers all.
Goodbye.